Charlie Bilello, founder and CEO at Compound Capital Advisors, joining us from the NASDAQ market site in New York City. Charlie, great to have you. I want you first just to introduce your firm and tell us what you're doing at Compound. Walk me through the objectives of your new project.
Yeah, absolutely. So we started an investment advisory firm, and what we want to do is try to help as many investors as we can. We want to hear your story and figure out a portfolio and a plan that can help enhance it. So we're going to be doing a strategic portfolio that has a global asset allocation and a more tactical portfolio that shifts between offense and defense based on some of the indicators that I've researched over the years.
Okay, and that research is well documented, or at least some of it through the charts on your Twitter. I've got some I pulled. But let's talk some big picture here first, because last year was an epic year for stocks and bonds. Which do you think investors need to temper their expectations for more?
Yeah, so, I think on the bond side, let's start there first. I think that it was an incredible year in the bond market. You just had the best year since 2002. The aggregate bonds were up almost 9% in total return. That's an enormous year given where yields are. So yields on the average bond portfolio today are around 2%. So I think investors need to temper their expectations because the best predictor of future returns in bonds is really that starting yield. So, the factors that were present last year that led to those enormous returns will be hard to repeat, right? You had this just huge move down in yields across, all durations. So you had the 30-year yield, of course, hitting its lowest level in history at below 2%. But you had the short end coming down as well with the Fed cutting rates. And you also had on the credit side, you had credit spreads tightening, right, as things started to improve throughout the year. So you had just had a hugely beneficial environment to bond investors. But going forward, that's going to be very difficult to repeat. So, usually that starting yield gives you a rough sense of what bonds will do over, let's say, the next 5 to 7 years. So look at that 2% as kind of a base case expectation and don't expect those high single-digit returns for some time.
Charlie, right now, there's a Fed cut that just got priced into 2020 the last couple of days, 60% chance now by the end of the year. There are many out there, and guests that come on the show all the time, and they go, you know what, I don't care what the yield is on the 10-year yield right now. I don't think it's going to go anywhere because the Fed still is in repos and central banks, and the punch bowl's still here. What do you think about that case?
Yeah, I think with central banks this year, it's going to be a little bit of a different story. Last year, it was just a global wave of easing. You had this setup coming in through the end of 2018 where crude oil crashed. You had inflation expectations moving lower. You had this trade war backdrop. You had fears of a global recession. And that really led to a wave of global easing that we haven't seen in a long time. And the Fed obviously cutting rates 3 times. I think this year it's a little bit of a different situation. The Fed now is on hold. I think if you see them cut again, and I know one cut is priced into the market by year end, but I don't think you want to see them cut a few more times this year because I think that it's going to mean that there's difficulty in the real economy, that stocks are probably down a good amount at that point, unlike last year when the Fed cut rates and stocks were at all-time highs, which is relatively unusual. I think if you're going to see them cut this year, you're probably going to see some weakness. So maybe we get that one cut, but if we get anything more than that, I think it's going to be a more difficult environment. So I'd say be careful what you wish for in terms of wanting more easy money coming into the markets here.
Yeah. Okay. Now, on the stock side, of course, we're back at pretty lofty valuations, 22 times trailing, basically the most expensive market we've had since Jan 18. We haven't had that quite, extreme degree of melt up like we did at the end of 2017. But it looks like there are some similarities. I mean, should we also temper our stock expectations?
Longer term, I think so. That makes sense. In any given year, it's really a fool's game to predict where the S&P is going to end of the year, right? It's just, that's a sentiment game. Yeah. How much is an investor going to pay? So you said 22 times earnings. Could they pay 25 at the end of the year or 30 times? Sure they could, right? We've seen that certainly in the late 90s into 2000. So anything is possible in any given year. But looking out longer term, really, U.S. equities are in the higher end of the valuation spectrum. So what I would be thinking about here from an investor is look at your portfolio, make sure you have exposure outside of the U.S. So if we look at the last 10 years in markets, U.S. stocks have just crushed international emerging markets, but we've seen many 10-year periods where the opposite's been true. So from 2000 to 2010, for example, U.S. stocks were down, emerging market stocks more than doubled. So make sure you haven't given up on some of those areas in your equity portfolio portfolio that haven't really done as well over the last 10 years, and as a result are cheaper on a valuation basis.
Charlie, your point here about the ability to predict, right, I think is well said, of course, even this year, right? Nobody had Iran tensions at the top of their 2020 outlook, and I read a lot of them. On the other hand, the fundamental side earnings, some might argue, okay, we can maybe approximate what we see there if we can get a handle on economic growth. I'm curious what your thoughts are on how that pertains to U.S. equities, though, because there has been pretty sluggish growth. The last 3 months of 2019 was kind of like this reflation trade, growth coming back, reinvigoration of the global economy. Do you see signs of that from the data that you look at? Do you buy that type of rotation we had the last 3 months?
Well, I think it's an expectation game when it comes to earnings, and it's very difficult to predict. Predicting earnings is maybe even harder than predicting long-term stock prices. So nobody last year, so through the third quarter last year, S&P 500 earnings were actually down year over year, right? And so no one would have predicted that the stock market would be up over 30% given that backdrop. So we haven't gotten fourth quarter earnings yet, but still the expectations are relatively muted for full year earnings. Coming to this year, I think people are expecting, mid to high single-digit earnings growth for the S&P, which would be roughly their historical average of around 6%. If we get that, would that be a positive or negative? Yes, certainly you'd rather have that than weaker earnings, but it comes back to that investor risk appetite. What are they willing to pay for that? And that involves looking ahead to the next year's earnings. So perhaps the weakness that we saw in earnings last year, coupled by the strong gains in the stock market, maybe the stock market, as you said, is anticipating a global reflation next year, economic growth activity increasing, maybe some of that manufacturing weakness that we've seen in the U.S. and abroad, maybe they're anticipating that rebounding and picking up this year. So certainly the expectations are high for U.S. equities in terms of where they're pricing in. The question is, will those expectations be met, or how much investors are going to pay for that given level of earnings? So that's a very difficult thing to predict, and that's why we try to stay away from those types of forecasts at all costs.
Yeah. Okay. One of the things that you have out, a chart that I love, is about profit margins. I wanted to get your take on this because the quote that you put on the tweet was that this is like the most mean reverting, thing that you can watch, and that sounds like maybe a little bit of rough news if you're someone who wants profit margins to expand, because they have been already. Does that mean we're in for a little bit of a crunch at companies?
Yeah, that quote is from the great Jeremy Grantham, great investor, and he said that a long time ago, that it's the most profit margins are the most mean reverting series in finance, and they should, if they don't mean revert, there's something very wrong with capitalism. So
it looks like they have been reverting for a while.
Right, so that's been tested and challenged, and I think he's kind of revised his thinking and saying, like, this time is different. We've had an extended period of elevated profit margins, and it's just gone on longer than people thought. We got those tax cuts, right, as well in 2017, and that pushed profit margins up to new record highs, and now we've kind of just hung out in that area. So the question is, are companies going to come in and provide increasing competition, lower those margins, or are we going to see costs go up, right, on the wage side? And we're seeing a little bit of that, right, certainly better wage growth, but we're still not seeing a meaningful decline, right, in profit margins. So certainly if that were to go down, that would put some pressure on equities, but it's certainly gone on longer than anyone can think, and the idea that it has to mean revert because it's been going on for a long time, I think that's kind of thrown out the window. Things can be irrational, or they don't mean revert a lot longer than you can you think they can.
Yeah, I love that point, by the way. Really well said. One of the things I hear a lot in the trade-off between growth versus multiple is that the stock investors don't need to worry about bond yields right now because they're not going to go up too quickly. That as long as there's not inflation, and the Fed's not hiking and all this stuff, but because there obviously was this extended period in last year as well where we were focused on the rest of the world, we cut again 3 times. Is the bond market that innocuous to stocks, or is there potential for multiple compression vis-a-vis higher yields?
I think people put perhaps too much emphasis emphasis on interest rates and yields in terms of stock multiples. I know that's an argument a lot of people make, but if you look at historically long term, there's been periods where interest rates are very low and multiples are low, and there's been periods where we've seen the opposite as well. So I think it's to put too much weight into that interest rate in terms of justifying a high multiple, I think is probably the wrong thing. Even in this cycle, we've seen interest rates on the 10-year go up above 3%, and we've seen them, last year approach, their lowest levels ever. And is that mix, is that change in interest rates really driving it? There's so many factors that go into equity prices. Interest rates are just one of them, right? So yeah. I guess the question is, all else equal, what is a lower interest rate or a lower funding cost for companies? Is it beneficial to companies? No question. But if higher interest rates mean that there's higher earnings growth and higher growth in the economy, then perhaps that's not a bad thing. So we've seen many years where interest rates have risen, and actually this is more often the case in a strong equity market. More often you see rising interest rates because growth is rising than falling. So if we look at the worst years in stock market history, if we look at the Depression, we look at 2008, we look at other severe bear markets, you see a collapse in interest rates. So because growth is falling. So again, I think it's a very difficult thing, and I think more investors should actually want interest rates on the long end to rise here, because it would mean economic prospects are increasing. If interest rates on the long end are going to keep falling, that could mean that we're going to go into a recession for the first time in a long time. So, yeah. I think all else equal, you'd rather see that rise. But certainly Fed expectations play a part in that, right? If the Fed is going to keep cutting rates, that's going to keep longer-term yields lower. But more important, is that going to be that inflation and economic growth? That's the biggest driver of long-term interest rates, more important than the Fed.
Yeah. All right, I got one more for you. This one is like a Rorschach test, Charlie, the chart of tech and ratio to the S&P 500. Because yeah. I love this, right? Some people, half the market looks at this and they go, hey, we got a long ways to go to get back to .com. We don't have to worry. The other half goes, what the heck is going on? You got to get out of technology stocks. Do you fall on either side of the aisle?
No, I don't have a strong opinion on any one sector. I think it's that would go against my belief in not predicting. What we can say about tech is that's where the growth has been, right, on the fundamental side. So it's not irrational that tech has had this tremendous period of outperformance. And last year, tech sector was up roughly 50%. This is the best year since '09, and before that, you got to go back to '99. So we're seeing that enthusiasm for tech, and it's based on the fundamentals, it's not entirely unwarranted. If you look at where the strong earnings and revenue growth is coming, it's in that tech sector, some healthcare names as well. But so the question again comes down to how much of that is priced in, how much of it is justified. We don't have the answer to that. We'll have to just wait and see. But we're certainly, if you look at that chart, we're nowhere near where we were in the late 1990s. So I think to say that tech has to go down, no, I think tech is going to be a big part of the economy for a long time. How investors will treat that is anyone's guess. Okay. But it should be a part of any diversified portfolio, and will be if you own just the market in general.
Appreciate it, Charlie Bilello, founder at Compound Capital Advisors. Great chat. Good to catch up, Charlie. Pleasure to have you.
Great to be with you. Thank you.
Thank you.